Assalamualaikum warahmatullahi wabarakatuh. Good morning, good afternoon, and good evening, perhaps. Today, I would like to share with you my opinion and initial analysis for a text that require about financial modeling in an annual general meeting, how to maximize an investment value with a key objective. Currently, I'm analyzing or doing some due diligence or analysis at HMSB or at HM Sabra, we call it. Moving further into the complex background, as you may know that HMSB stands for the Hanjaya Mandala Sampurna Tbk, which it had become a company who had a majority in the industry of tobacco manufacturing, which previously it's an own company from Indonesia and pretty much well known of its Kisamsu or Raja Kletek, which later on being acquisitioned as one of the subsidiary of a well-known global tobacco manufacturer called Philip Morris International. And currently, AM Sampurna, well known of its product portfolio such as the IQOS and Teria, other than Raja Kletek, yeah. And its vision is to be regarded as the most respected company in Indonesia, with a mission of a tangan-tangan. So the tangan-tangan itself, it's considered of a three pillars of a strategy, which the first one is acceleration and building a sustainable multi-category role model and ensure by our smoke-free products portfolio. Second part is maintaining market leadership in our core combustible cigarettes and embracing adult consumer preference and deepening our portfolio strength in each product category. Last but not least, it's about creating sustainable value for a broad range of stakeholders, from our employees internally and local farming communities to the micro, small, and medium enterprises that which contribute so significantly to Indonesia's economy. And in this company, we would like to refine its strategy, perhaps by doing some due diligence and financial modeling, the simple one from several financial aspects, such as the ROA, ROE, two-point analysis, competitive benchmarking, and many more about that, which it will be elaborated moreover within the next slides. Here's the executive summary, which I have mentioned before. We would like to do some comparison between its financial performance evaluation results and how do we gain all of the insights towards producing into the strategy solution itself in here will be elaborated more over, which is the financial performance. What I would like to say about IM Sampurna is that they will able to maintain a strong resilience in the revenue generations, which from 2024 to 2024, they managed to always to earn more and more in here. But what becomes a concern in here is that the return on equity, which declined from 27% to 23%. Yeah, it's estimated by 4% in here, which they do mention that coming from the shareholder return that it is primarily driven by the margin conversions instead of a later leverage deteriorations. But knowing that the market of the combustible cigarettes and yeah, just in general cigarettes, we've known that there are some declines that is being faced by BAT as well. Also, BAT almost lost about like 55% of its revenue, and this might become a valid, but we could not depend solely on this matter because a company would be so great if they could stand strong within any occurrence of errors, such as, yeah, those are one of the many things. Continue the next step, we would like to talk over about the asset turnover, which it's pretty much improving significantly each year to year, and this indicates a strong operating productivity despite a stable asset base and conservative capital structures. Yeah. So to put a note in here, this is one of the many key strengths of HM Sampurna, which this will be explained more over within the next slide. Continue to the valuation results from the discounted cash flow. We may found out that using the calculation of a 10% ACC with every capital cost and 3% of the terminal growth, we could produce an initial value approximately by 770. Yet, what does the value will be widespread into each range? So let's say the upside and downside. So it's pretty much from the calculation itself, we found out about the downside is about the 624. And as for the upside, we could estimate about 1,031, which in here, 770 is stands within the mid of it. But we could not just solely decide that it is in the mid and we just say it's very value or not. There will be a comprehensive explanation about that later on, but we could consider that the HM sample appears fairly valid with limited upside and downside. So the key takeaways that we would like that I would like to share with you is that the revenue performance is structurally resilient. Yet the profit conversion, I would say that profit margin is pretty much impacted. It's being weakened in here, but the asset productivity in here is pretty much okay. And the ROI remains strong relative to peers, but it is increasingly dependent on operating market recovery instead of financial leverage or internal funding. So in here, the road to market efficiency as well is considered as one of the structural strength of a HM Sampurna, and the liquidity remains adequate because we found out that the company able to operate and buy its own metal without any debts or like a small liabilities, I would say about that. And as for strategy solutions that I would like to perceive in it, there will be three general that will classify most of like about 28 solutions in here, which most of them are related closely with the margin recovery and pricing discipline, like the pricing mix premium and leverage portfolio and etc. And then road to market productivity. And last but not least is the capital allocation discipline and ROE governance itself. By how do we get the higher return of a portfolio segments and avoiding leverage driven return engineering. Moving on to more details, here is an overview of our profitability ratio in the sales. How do we see the company with the revenue growth towards the comparison of the sales itself? So we would like to see in here. So there's a questions that we would like to ask in here, and it's about can here and Samporna still convert top line growth into the qualified or quality earnings, high quality earnings in here? So that I could say in the general that the top line remain reasonably stable. So in here, we could say even it's the trend is coming down, yet the it is caused by the profit conversion that has weakened from the year to year itself. So yeah, the things in here, it's not about the sales sometimes, but we need to consider more details about it and found out that they could be about net profit in here. And so far, there are several key highlights that I would like to share with you about the margin itself. Actually, 2023 is considered as the best rebound year in here, despite of its volume being declined by 4%. It still has a good ratio in here, such as the ROE up to 40%, ROE 27%, and the margin itself by 7% with a market share of 28%. So it's still considered as moderately good in here. And as of for 2024, it's been weakened in here. Well, although that the management explicitly linked this to the inflation pressure, excise increases downtrend, and due to the secret sales is being declined, we need to do some due diligence in between to reassure that this is the core issues of the weakening of a profitability ratio, which is why in here, what I would like to perceive that do some analysis, initial analysis, I would say not due diligence, so found out that the net profit margin, it kept growing from 2021 to 2022 until 2023 and 2024. It's still significantly having a good growth, but found out that the end net profit did not hold so well. It's because the top line of a residency is not able to fully translate into the bottom line quality of the whole revenue. So means that this is something that the manager should be aware of. So we could recommend three parts of it about the tighten the pricing architecture by segments to leverage the net profit margin again, and then defining the premium mix where it is possible. And last but not least is maximizing the smoke-free portfolio to rebuild margin quality, not only just by volume, but it's about its pricing quality. Moving on to the next step, we are going to move with the liquidity ratio, which in here we would like to preserve to see and do some analysis about how HM Sampurna can be comfortable to meet its near-term applications using liquidity and their liquid resources. So in here, we could say that Sampurna able to preserve liquidity quality while preventing further erosion of the short-term buffer. So in here, we may know that from the current ratio that HM Sampurna remain liquid and operationally safe throughout the 2020 to 2024. But the decline from the 2.45 to 1.63 shows that its short-term liquidity cushion has been narrowed. So which means that this working capital discipline is becoming more important in here. Although we found out that based on the 5-year signal itself, you know that it's the liquidity level of the HM Sampurna, but we could put this signal as not a distressed liquid of ratio. I would say about that. And we could recommend that we need to protect liquidity about how to sharpen the working capital management in here and preserving cash conversion quality by sustaining fast receivable collections to reassure that the account receivable is minimized in here and keeping capital deployment selective until short-term flexibility stabilizes. Continue to the next step, efficiency ratio. So we would like to know about the strength of its capital structures. Is it remain conservative? And do the shareholder return is being driven by leverage itself? Well, yeah, as we could see from the HM Sampurnas, our key findings mentioned that the company's financial position is supported primarily by internal funding rather than debt reliance, which is, it could be good, but it could be a threat as well in here. So let's see deep down through the efficiency ratio, which I have mentioned about three key highlights in here. Some of them might be redundant, showing that Higham Sauna does not depend much on debt to finance to its business, which is it's a good thing. And liability to asset, let's just ask about if the company able to pay the material not by debt, then how do they pay? Let's see about the liability to the asset itself. That's why it's being checked in here. And this is just about a tighter balance sheet funding condition than 2020, but not in the financial distress condition. But because of the leverage level is remained low in here, changes in the return on equity should be attributed mainly to profitability and operating efficiency, not within balance sheets. Based on those three keys, we would like to say that there are several solutions that we would like to achieve it in here is that about maintaining conservative leverage to preserve resilience in a volatile asset environment. That's the first step. That's the second part is a prioritize internally funded growth and being selective capital deployment, which means we could try to put more strict management toward how the fund being allocated and how it's being managed in here, and keeping the ROE improvement focus on margin and asset productivity, not financial care, especially that the Aham Summer has a strong asset productivity in here. This has what management should be aware of is that they need to maintain this or sustain this. Perhaps it will be a good thing if they could leverage it more into the next level. Next one is asset turnover, which I have mentioned before, that we would like to see if this part is good, if to check rather than to see how M Sampurna able to generate more sales from its asset base, or perhaps from the other spaces. So in here, we have decided to draw two key highlights in here to see apart from the end from the year to year from the 2020 to 2024, we found out that the asset turnover is leveraged greatly from the 1.86 to 2.15, which we could say that the HM Sapra are able to generate progressively more revenue from its asset base. So there could be several signs that could imply from it, such as the inventory level is pretty much low, and the turnover will be level so high. That will be one of many parts in here. Next step, 2024 efficiency improved, but part of the gain came from the denominator effects. What does that mean? So that means that it might be affected from other aspects, I would say, such as the 2024 reports mentioned that the total asset fell mainly due to lower intercompany loan balance, while the inventory increased. So this has to be one of the many that needs to be considered moreover within the future. So a further due diligence or analysis should be needed in here. What we could produce as a solution in here. So there are three parts. The first one is we would like to improve again the asset productivity. Sustaining is good. Improving will be a better options in here, of course. And then how do we approach on it? That means we could go with a more selective capital deployment. That's one of the main things. And as for the next solutions, we could preserve a strict receivable disciplines to maintain that the flexibility of the company able to pay its metro will be much more better. And last but not least is to optimize the inventory and asset mix so the efficiency gains remain sustainable in here. Continue to the next step, we will move into the Pong analysis. So in here, we will like to emphasize how the company will be able to drive its profit and equity and asset productivities. So we would like to see from three parts of a ratio. Is the first part is the asset turnover. Second part is a profit margin, and the third part is equity multiplier. Let's just say in here, from the net profit margin, we could tell that when the net profit margin fell, means return equity also falling down, or let's say decrease. So the main issue that the HM Samura here have is that they are not weak at the revenue generation, despite of the declining level of a volume at 2022. This doesn't become a bother things towards the HM Samura itself because Samura able to generate revenue, but they will not be able to produce a high profit in here. So that means the net profit margin in here needs to be aware of towards the management. Even though they have explicitly linked this pressure towards the inflation, excise increase, and tundra and illicit rates, this doesn't mean that there might be other factors that should be considered in here. As for the next step, we would like to discuss about the asset turnover, which in here we know that there are several things to help to say about the asset turnover that we know that asset turnover improves steadily, which means that HM Sabar generate more revenue from each asset. And this will help us to know that the revenue is being generously from HM Sabar, while the total assets did not expand at the same pace of the revenue, which is why this is also a great thing. But this notice another thing, such as the other parts, such as the net profit margin itself. This also become a stronger stances towards the net profit margin needs to be aware of towards the management. Last but not least, it's about the equity multiplier. We could say that debt to equity is still near to zero, which is why in here, we could say that it is great because the company able to finance its all material of variable cost despite of a high debt. But in here, leveraging in ROI is not the main importance to tackle. And we need to emphasize more in internal funding strength because we know that there are a lot of internal funding that we need to be more selective about it to allocate those capital into a better innovation excellence of a HM Sampurna. So based on those T ratio itself, we could figure out that there are several key highlights that we would like to discuss in here. ROE remains strong. Asset turnover improve consistently. Third part is that leverage stay conservative, so ROE should not be interpreted as a debt engineering. And last but not least, 2023 ROE recovery came from stronger profit conversions, and 2024 weakening came from renewed margin compressions. And based on those four key highlights, I would like to say deliver three recommendations in here. Which the first one is prioritizing at what the margin defense. Net profit margin is becoming the main swing factor in here. So as for the second part, sustaining the asset productivity through selective capital of interfunding is also a must. Last but not least, we need to maintain a conservative leverage and focus shareholder return improvement on operations, not financial instruments. Which is why in here, although that we have to some initial analysis of a two-part approach towards HM Sampurna, we would like to see a deeper down on other competitor within the same industry. Which in here, we have proceeded some initial analysis on the Pentel Group, or we could say PAT. So PAT itself is pronounced when well of its cigarettes of a Pentel SJT, Kretek, rokok Kretek, or Tunhel Filter, Tunhel International, which in here Pentel Group is considered was as one of a well-known tobacco manufacturer in Indonesia and also globally because it is a part of a group of a British American tobacco. So the PAT Group itself vision is pretty much the same. They have the same missions as well to reach out a better market, improving value of their combustibles, supporting the SDGs program, developing Indonesian human resource to become a world-class quality, and many more. And we would like to do some benchmark comparison with the Handaya Mandala Jaya Sampurna in here. Could be from the asset turnover, ROE, and many other ratios. So in here, actually, I would like to emphasize how the company will be able to drive its profit, equity, and asset productivity through these findings, the lecture and annual report that I have to note it more over within website. So the comparison that I have done in here is using the 2020, and we could see that based on the asset turnover, equity multiplier, return on equity, and also gross profit margin, we may know that there are some distinct and disruptive, very different, I would say, the gap is huge between the ROE of HM Sampurna and Bentul Group in here. And also the gross profit margin, not to forget about mentioning that notes. So in here, I would like to put some key highlights that HM Sampurna has its own prowess and managed to be in the better standing instead of Bentus in front of these numbers. But here is an overview of why would that it will be interpreted like that. And perhaps there might be some notice from notes. Perhaps will be some notes that we would like to save with as a matter for a very comprehensive analysis in the future. So starting from the asset turnover, I could say that HM Sampurna able to deliver about 1.86 of its asset turnover and 1.11 for Pentul in 2020, showing that HM Sampurna able to convert its asset base much more better into revenue, much more efficient. This indicates a stronger operating scale in the sales and commercial execution. It could be a road to market strategy that HM Sampurna had is much more way better, or could be much more way fit to the market share that they have. It could imply to those kind of things, which is why in here, the implications that we need to be concerned of that management should be aware to protect this lead by keeping the asset expansion, be selective, but able to expanding, especially in the smoke-free. It's becoming a huge market that need to be catch up in Indonesia. And we would like to prioritize asset that directly improve to the revenue quality. Being assertive toward its margin is a much more way better to a better company. And I come moving further into the return on equity. So the difference between Pentus and HM Sampurna is significantly huge in here. So it's about 0.5 times, much more. And we could say that HM Sampurna has much more healthier business account, while Pentus did not convert to return that fast. While we know that even though that there's already yeah could be distinct by 0.5, we need to be reassured towards the management to maintain the ROE through stronger operating margin and asset productivity. Reassure that we are still in the top notch of the market. And as a gross profit margin, there's a huge difference about 20% that we could say that HM Sampurna is winning by this market. But otherwise than that, there is an important note that they have. So back then, at 2020, PAT facing a huge sales decline, which was about 55%, which this might affect the comparison in between. But the key notes in here that HM Sampurna must defend its gross margin through stronger price back. Of course, that's the first thing. It's because the profit margin. We need to set up a better premium mix management and discipline this cost productivity to ensure that everything is still efficient and being handled wisely. So in here, we would like to draw from all of those implications. That means there could be about three relevancy towards a new strategy, which is about again leveraging margin. Second part is improving asset efficiency or sustaining at least. And the third part is paying selective investment in the higher quality revenue of a making portfolio. So here is how it will be impacting to this new financial ratios. If those key strategies will be implemented, such as I was to say there are three common key strategies, such as the revenue quality refinement, road to market densification and channel productivity, selective capital expenditure and asset like scaling, and for the equity multiplier, that means we are going to be more conservative about funding mix of internal and also external, self-funding growth for stability to debt, working capital and liability control. And continue to the next step, which is the gross profit margin. We could say that there will be pricing mix management, premium and smoke-free mix portfolio expansion, supply chain operational productivity, margin-led ROE recovery, capital allocation discipline, low leverage, value creation. But even though that we have those lists of strategies that also we have projected this towards the 2029 from 6 to 10, I would say from the previous as well to the same. We still need to have some other key assumptions and perhaps because we know that every market might be impacted towards the POV of an investor, which means we are going to do some analysis towards that. Which moving further, we are going to discuss about several aspects such as the income statement projection. That's the first thing because it was also being reflected towards the previous chart. Of course, coming to the next step, it's a free cash flow to the firm projections. We got average capital cost, sensitivity analysis, and valuation to tell if it is paying for value, or undervalue. This might be an important factor to consider because this is where the funding will be going up. It is one of the main important thing. It's not the major thing, but it's a top to consider as well. So in here, I have put some key assumptions which were governed through the automated formula from Cooper Finance Institute, and some are being averaged towards the previous year. Because of what? Because the strategy that has been implemented by the HM Sampurna currently are about the same. Yet we don't know about its technically, about its detail, and also many more aspects to consider within each divisions. Which is why in here there are examples that could be average, such as the revenue growth, cost of a goods sold, salaries and benefit, and then other income, other expenses, rent and overhead, depreciation and amortization coming from the NCE, which is non cost, and then Interest tax rate is coming from the formula, and on account receivable, inventory account payable is coming from the income statement as well considerations. And then for the capital expenditures, it was also allocated from the income statement. For the total days in the period, for a year, I consider about always stable in the 365 days in here with a dividend payout of 90%. And in here we could gain the new income statement projections apart from the revenue, its expenses, its profit before income tax, its net earnings from the 2025 to 2029. So back again to our previous discussions about how one of the main important things is about coming from the funding, and funding is coming from the investor. Investor is coming from this analysis. This is the discounted cash flow and free cash flow. So this is a construction of a free cash flow to be projected from 2025 to 2029. So in here, let's just say with I have made sure and do some comprehensive calculations throughout the 2025 to 2029 and got a notation about the free cash flows is facing an uplift, having uptrends, means that the operation has been held efficiently and strongly managed so well. Not in the terms only on the operation activity, but also in the fund itself. But we need to do some comprehensive analysis in here. Found out that the capital expenditure remains stable, but the strategic expansions or perhaps the portfolio leverages might not yet taken seriously in here. Yet it could be solely taken insight from this only one. It requires about more comprehensive analysis from the internal divisions and many stakeholders. Moving on to the next step, working capital, it remains stable. In a good position, it could not be interpreted that this might be face spikes throughout the 2029, which is why there's a decrease up to 11%. But is it still sustainable? Yes, it is still sustainable, and it's still in the good terms because the operations being operated efficiently. So here's the important step. It's about the weighted average cost of a capital. This is how the investor will see, and how do they see? How do they put based on their own rates in here, and how do we measure about HMSB considered as a good investment or not? So based on investor view, so I'm using, even though that HM Summer already mentioned that they use equity experiment of 8.6%, if I mentioned through one of the ledgers. Actually, I would like to have a same stance or same standing within the older market within the tobacco manufacturing, which found out that I use Kroll, which is one of a well-known boutique consulting and deal advisory and discovery fees, which is provide service in the turnaround, restructuring, and many more about that. Perhaps PE as well, but yeah, Kroll is pretty much an alpha turnaround. So they use normally about 5.5%. Those are the key assumptions that we use in here. And using that assumption itself, we found out that there is a weighted average cost of capital about 10%, right? It reflects a conservative capital structure with a limited reliance on leverage. Cost of equity remains the dominant driver of discount rate due to strong internal funding capacity and low financial risk exposure. It supports the enterprise valuation and the margin net growth assumption rather than debt driven returns, which is it is currently describe how the Sampurna has been operating right now. Okay, moving to the next step, the discounted cash flow and how do we see the intrinsic value compared to its upside and downside based on the present value of a free cash flow to firms. So which in here, we could say that we are using the terminal growth rate of a 3%, which is pretty much common in the market. So we use that as a stances to develop more over details of the valuation in here to reach out the conclusions. But we could say that in here, based on the we use the template of coming from the Corporate Finance Institute. We got that it is being fairly value about with a value of a minus 8.5%, which it's under of a 0%. It's below zero, which is to compare with the upside and downside means that the interest from the investor side might be relatively moderate to this company, but there are also other considerations that might become as uncertainty in here, such as the favoritism in the product. Looking from other aspect of the fundamentals, uh, a good consideration to have in here. Continue in the next step, the sensitivity analysis. So we do some checking uh, about the sensitivity itself. We may assume that this indicates that the interest rate remains highly dependent on the principles of a discount rate and perfect growth assumptions. And based on that, even though that we known about its intrinsic value is estimated by the 770, with a downside of a 624 and upside of a 1031, we could say that it is still an mid, might be in the between our value and our value. But in here, based on our judgments and our brains that we have received in here, we gain that that HM Samana is considered as a value. But based on the sensitivity and discounted cash flow itself and every ratio that we have measured previously, we have three general recommendation to prioritize which in here. It's A is a margin-led operating advantages. B is a strict capital management and or governance. And C is asset efficiency and go-to-market productivity, which we have about up to, yeah, I could say estimated by 28 solutions to uplift based on other ratios as well. So here's an overview. So I have put three general recommended solutions, but it could be developed into 28 solutions that could be based on several multi-criterion of ratios. Such this is the first example. It's about preset price back architecture by segment, and second part is product premium mix in high contributes SQM. This impacted by the NPM, gross profit margin, return on equity. And for the second solution, the profit margin, return on asset, gross profit margin. And as for the right column of the solutions, it defines about how detailed, yeah, I will say two steps of the detail of the solution itself. For example, the preset price back architecture by segment. From the evidence itself, we know that the sales revenue generation at Time Summer is great, but its ability to convert those as the more profitable of revenue is still uh, something to be aware of towards the management. So which is why in here, we need to redesign again the price later by SKT, and SPM over 90 days to test out, uh, to test the elasticity quarterly to improve just how many net revenue that we could stick with at the maximum level. At what level that the revenue might be impacted by the pricing itself. So we could test out about the maximum level of the pricing and the lowest level of a pricing itself. In here, we could try to leverage the margin of tensions after several exercises. That's one of many things. Continue on the next step, product frame mix in high contribute SKM, which we are going to set share of mix sockets for frame SKM, moderate, and tracking all the margin by brand family monthly. This will help us to be able to drive more data-driven analysis and producing a concrete solution of decision making in the pricing itself. And according to the next step, to manage, put an access space through playbook, and reallocate trade spend to high contribution channels, which is we could not only consider about the price ladders, but also try to sustain the channels and also the revenue generations. Perhaps we could level up the game up to 2.0 of the sales gains. It could be good things to have. And then and there comes up a Titan Cruise to net governance, then up a combustible profitable cockpit, a smoke-free margin ladder, which is a fall ledger, launch a manufacturing productivity wave, front level contributing SKUs to keep the inventory as low as possible. And then it comes about intensifying the road-to-market strategy in high productivity corridors, and then tile outlets and redesign productivity, which is like a centralization or perhaps putting ABC metrics. So it's like considering about the high risk, moderate risk, and low risk of outlets. We may put classification based on itself and many other. So to be assured that every inventory could be kept to minimum, and every life cycle of item itself might not be too long. And moving on to the next step, scale distribution asset like tight capital expenditure approval to turnover uplift, maximizing Karawang or export platform utilization is one of the many things. And then this is one of our most important thing, which is converting R&D into the commercial hit rate. Which is why in here, this will be a huge innovation excellence game and might be dedicated into linked towards the revenue to test out. So in here, we are not going to match out with the market share, but to test out the real market towards the product to see how great our belief that we have in here. Could we maintain it? Could we keep it? Could we leverage it to the next level? So in here, we need to launch fewer, better support fibers rather than broad and differentiated launches. So this will help us to stepping up the game as well in the premium prospect uh, management as well in here. Next step is a tighten the demand sensing and inventory disciplines. Is a one of many things about the putting ADC outlets and then install receivable squad rails by distributed tier. So this is to keep the receivable to the minimum level. And then synchronizing supplier planning for size and materials. And this will we are going to implement the joint planning uh, between one supplier towards the other. And then set a conservative leverage ceiling, make self-funded growth to the default policy, link dividend back into free cash flow to the firm coverage, create a working capital common center, establish an ROE-based capital allocation committee, run zero-based SG&A overhead productivity. And then there would be the last three is PAT responsible, not a bad PAT imaging. It's more likely towards the competitors program. So this might be a good idea for us to have a company that help us to identify all the competitor strengths, weakness, and threats directly coming from the market. We could perhaps try to identify its needs of the solutions, problems, or opportunity or threats towards the vendor and also supplier. Stand up a PMO for the three strategic pillars, and also not limited to the three strategic pillar of a tangan-tangan, but also towards the all recommended solution that we have proposed in here. What management insists to develop it, they will have its own PMO on its division. And this will help us to give a chance to retain an employee or any employee within any division that will voluntarily to help act as a PMO to deliver a better innovations towards HM Sampurna, which is it's part of a 28 recommended solution. Case getting a value creation for scorecards into incentives. So it's like you're putting target towards the self, but it's different, such as the R&D. R&D might be related with how powerful, how impactful the product will be, how big the market share will be generated will be allocated towards the account of the other salesperson. But in here, because previously we have also measured and giving ideas of a R&D will be allocated to the uh, revenue generation as well, which means this might be a new game uh, to consider and to be developed with. This will require a further benchmark, not within the same industry, because I haven't seen of any company or companies that implemented this. Yeah, that's so far about my findings on how the financial aspects being converted into the strategic solutions that we could inquire for HM Sampurna. I think that's so far I would like to say within here. Can you let me know if you do have some feedback for users towards this financial modeling or perhaps market assumptions or the way that I could elaborate more within my PowerPoints and so more about that. Have a nice day and happy Eid Lebaran.